Okay, ladies and gentlemen, good evening and welcome to the fifth Tech Capital Markets webinar, chaired this evening by Keith Cornell, who has been a serial entrepreneur and CEO, and will be talking tonight of alternative venture funding. And I'll have, of course, simple and obvious question for him, first of all. But before that, two logistical questions. First, this session is being recorded, and you should know it, and it will be published on our website for future reference. And secondly, you may put any question at any time through the Q&A interface of Zoom. And and all questions will be answered at the end of the webinar by Keith Cornell. So Keith, is there any chance that alternative venture funding is going to continue and there's going to be any such thing in the face of COVID-19?
Well, I think, John, it's a question that I'm going to go through a couple of ideas here. Do I think those ideas are going to catch fire very quickly right now? No. But because of COVID-19, I'm also going to talk at the end of my presentation specifically about a few old ideas that I think would be very helpful during this time.
Okay, please go.
So I'm hoping you can see my screen clearly. First slide is a little bit of background on myself. Yes, I am speaking with an American accent, but I've lived in London and been managing small companies in the SMB sector for the last almost 20 years. When I say SMB, there's a lot of difference of opinion of that. I'm talking about companies that are sized between 5 and 50 million in revenues and 25 to 500 employees. And those are the kind of companies I've worked with. As we talk about ventures in this, I'll also be talking about startup ventures, which obviously are working hard to get to that size range. But I've been a CEO of these kind of companies and a chairman for the last little bit of echo there. So that's my background briefly. I have done some presentations with ASA in the past. The last 3 years, I've been presenting on how to build better boards to a number of CEOs in this SMB sector. So that's my background in terms of ESA. I want to bring this back to the content. John asked the interesting question, are we going to have venture funding? And the answer is I absolutely think this will continue. I'm going to give two platform ideas that have just started to become available out there for funding. In order to do that, I'm going to talk about crypto assets and the crypto asset process. I'll then come back and say, why do we seek equity funding, and talk about some of those alternatives I mentioned relative to not just COVID-19, but just relative to what happens if you can't get funding or if your funding alternatives seem not attractive, shall we say. And then, as Jean said, we'll go into a Q&A at the end. And don't hesitate to type in those questions as you have them, and Jean will make sure we moderate when we get to the end of the presentation. I want to bring this back into context of this project. So this is an EU project with a number of participants that have led to the various webinars that have been held. Most of the past webinars have been talking about public markets and about IPOs and that sort of thing. I'm taking us back a step and talking about alternative finance for equity and really the venture process before you talk about getting to an IPO process. I'm also talking about a new funding model that I think will be very interesting to all of you. And in particular, it does leverage distributed ledger technology or blockchain technology, and I'll explain a little bit more about that. Again, this project identified a number of challenges to venture funding in Europe. I'm going to be touching on several of those challenges in terms of retail investors, in terms of listing costs outweigh the benefits. We'll talk about a platform that the cost is very low, lack of liquidity. So I'm going to be touching on a number of these challenges, and that's part of the reason, of course, for this webinar, is to look at these challenges. And this project also identified 5 recommendations I'm going to talk about a bit of matching and buyers of sellers. And in terms of, I won't necessarily say the IPO process, but I'll talk about retail investors, and I'll talk specifically about financial inclusion as we talk about one of the platforms. So again, to go back to the content, what we're going to be talking about, first off, I'm going to start with crypto assets, define what those are, make sure people are comfortable with the concepts, talk about tokens, and then using these tokens, I'm going to talk about these two new platform ideas as we move forward. So what is a crypto asset? If you think about the past and you think about barter in, say, the caveman days, you would go and barter a killed animal perhaps for something else. And that moved into cash and moved into the fiat currency that we use as cash. And if you think about the next part of that, as we move that cash to securities or moved it onto credit cards or stored value cards, in effect, what we're talking about with crypto assets is the digitalization of these kinds of assets. And the key with this digitalization is, how do I know that the crypto asset is in fact something worthwhile or something worthy of getting it? And what's occurred here is using blockchain technology. And if any of you are interested in how a very simple way to look at blockchain technology, there's a great BBC video on blockchain technology that you could take a look in a search and get. In effect, what it does is it enables us to have a ledger, to have, if you will, what this asset is and why it's worthwhile, distributed amongst a number of individuals or a number of computers in this case. And what this distributed ledger enables us to do is create a consensus mechanism that causes us to believe that in fact the crypto asset is what we say it is or what we think it is. So instead of having a single source of getting this knowledge, you have multiple unlinked or unrelated sources that allow us to then say, okay, I know that this asset is real. The digital rights are there. I can take those digital rights. I know what that ownership is, and I know what the consistency of that ownership is. So that, in effect, is what causes us to talk about crypto assets. When we talk about crypto assets, there's a number of forms of these tokens. I'm going to talk about 4 separate versions of these tokens. So a token is, in effect, the digital right, the digital representation, rather, of a right to a particular asset. Some of these can be regulated and some of these can be unregulated by financial authorities or by governmental authorities. But they're categorized by what does the right actually give to you. In the first case, talk about utility tokens. So a utility token provides you the ability to get a prospective product or prospective service. You can have very, very different uses of that. That service could be to purchase goods. It could be to have a wallet that holds the asset for you. It could also be to create some type of trade or some type of barter system using a digital asset. So in the case of BAT Brave, those are actually trading advertising rights or advertising capabilities across a platform. The next one, which most of us think about when we think about a crypto asset, is of course digital currency. We've heard a lot about Bitcoin and those kinds of currencies. And what that is a value or a stored medium of, think of it as currency, but it's not a fiat currency, as in it's not a euro or it's not a dollar. And there is no government that says, oh, we guarantee that we'll have the ability to be used in a marketplace or to have a certain amount of value. Those particular coins, there are a number of them in the marketplace, and the value there is the value that's created by the belief system of that particular exchange, in terms of there are buyers and there are sellers, and therefore they create a marketplace, so to speak, for the value of that digital currency. The next stage in that is to take a asset or to take a stable currency, for example, a US dollar, and create a token, so a digitalization of that of that stable background asset. And you can find these out there that are designated in terms of dollars or in terms of gold or a particular asset. And they believe to have lower volatility because, in fact, it is not a supply-demand issue. It's you're buying a particular chunk of something. And that's what a stable or a token is like. If we take that to the next stage, what's the digitalization of equity ownership or the digitalization of debt? And that, in fact, becomes a security token. And it's a way of being able to take this intrinsic asset, which used to be represented by a security that will have some sort of authority behind it, and digitize that and say, here is the electronic version or the digital version of that particular either stock certificate or debt instrument or whatever. And usually what that security token allows you to have is a certain amount of rights within terms and conditions that give you benefits to that particular underlying asset. Now, as we think about crypto assets and the whole move, there's a number of these that have been growing, a number of different asset classes that are out there. The market value of this is estimated somewhere in the 300 billion US dollar phase. And when I talk later on about one of the platforms, there's a belief that there's as many as 30 million individuals that are trading or have used these kinds of crypto assets. On the right-hand side, not designed to be able to actually see, but there are over 2,000 different tokens that exist and have been out there for the past couple of years and continues to grow very, very quickly. So I now want to stop having talked about these crypto assets. I now want to talk about two very different platforms that could be used by ventures for funding in the future. In both cases, I want to make it very plain. I do not represent either of these two ventures, so I'm giving you information. Both of them know I'm talking about them. Through Jean, we'd be happy to connect you with them if you're interested. But I want to give you just two different ways to look at how crypto assets could be an interesting way in the future for venture capital to be used or for ventures to get funded. The first one is a platform that's offered by Consilience Ventures. Their objective is to create a more efficient process for entrepreneurs to get funded and to create a more scalable capability both for those businesses and for Consilience Ventures, or what I would call the platform itself. What it does is it brings together three groups. It brings together startup companies, investors, and advisors. And it creates a community across those three different groups where a token, a security token, becomes a form of equity security. Think of this as a closed garden. And on the next slide, I'll show you more about that closed garden. But this is a closed garden between a group of startups that have taken investment by Consilience Ventures in the form of tokens, a garden that includes a set of investors that's invested in these tokens, and a set of advisors that are working together to help those startups get better and scale up. It is disruptive, and it's very, very interesting because what it does is it creates a very scalable community that these community of both investors and advisors help to find, fund, and grow these particular companies. And so to me, it's a little bit of moving from building a car one at a time to a little bit more like Henry Ford did with the assembly line and create a industrialized venture capital community, investment community that can grow very, very quickly. There is no carry or fees charged to the investors. They're buying the particular tokens. Those tokens are then being used by the company and by the advisors. What's also interesting is as you get into more complex venture capital funding, you almost always have issues around the cap table. How many investors, what sort of carry do they have? What sort of rights to those different types of different forms of equity have, or are there differences on the cap table? And I think this is a very, very interesting example of a new platform where you bring these parties together, and what you've done is the startup has a certain number of CVDSs, or these are if you will, these digital tokens, digital shares. The startup will receive X amount of CVDSs for X amount of equity. So there's a transaction there between the startup and the particular tokens. The investors will have put certain tokens out there for a certain amount of cash. That cash can also flow into the startups as a certain amount, or can flow to the advisors, or simply sits there as stored value to be used by the startups or to be used by the advisors. The advisors work with the companies to help those companies in a variety of services. Those could be legal services, HR. It could be, for example, technology or development skills. All sorts of different advisors are in this community. The investors are also benefiting from those advisors' knowledge, because what it does is it creates a network effect for the investments and for the investors to grow this particular, if you will, portfolio of ventures. So this is, to me, a very interesting community. It is up and running. They've made their first investments. There are a number of investors behind it. So this is not something that is going to happen. This is something that is happening. And I think is going to be extremely interesting to see as it moves forward. The other thing that's interesting about this process is, and I've had this happen where I've done a B round for 10 million pounds, and the 10 million pounds flowed into the company. I then had a year and a half to spend it to grow the company. But I had to make that transaction all at once, which was, let's raise 10 million, let's go walk Sand Hill, let's go out to London to the normal VCs and get this done. In this particular Consilience Ventures, you're able to actually get the CVDSs a little bit at a time. So what you could do is you could drip out your equity, and in fact, you would hope get a higher valuation. The expectation, of course, is that the CVDSs are growing in value. For the investors, they're getting a portfolio that's fairly broad. For the advisors, they're getting the access to these companies and bringing companies into the fold. So you can see there's a lot of interesting synergies that can occur with this particular platform. I'm next going to talk about a different platform, and this comes back to the comment I made earlier about financial inclusion. So SupraFin, which is a London startup, the page I'm going to show you next, it's about a month off of being launched. But what the objective here is, if you think about a portfolio of equities you may have at a stockbroker, and you have a certain number of equities, you have a certain number of bonds or debt, et cetera. So you have there a platform, if you will, or you have a number of investments sitting on a platform. What SupraFin is doing is creating a wealth tech platform that will invest in a number of the kind of tokens that I've talked about, in a number of different crypto assets. The idea being that they would like to have retail investors, and financial inclusion meaning as little as 100 euros can go into this platform. And you can go out to the retail investor and you can say, hey, this is a new form of assets that can be part of your investment portfolio or part of your savings. And you can put in a small amount, you can add to it every month or as often as you want. And what this wealth tech platform is doing is bringing together a number of assets onto a platform and creating a proprietary investment model that says, if your risk level is this, we'll give you these kind of assets. So you go in as the investor and you say, here's my risk profile, here's what I'm looking to do, here's my time frame. And SupraFin will create a portfolio designed around you and designed around your risk profile. So again, to come by, why is this an interesting platform? And to me, why is it interesting in terms of disruption is, first off, venture capital is not a place where you normally see retail investors, for the simple reason that the limited partnership process is a fairly complex one. And in this particular case, you're able to go to this platform with 100 euros and say, okay, I want to participate in these particular kinds of assets. So the reason I bring this up for us in this call is I think this could be a very interesting form of distribution for crypto securities of a particular venture. So you would go out and say, I'm going to raise X amount of my company, and I'm going to use a crypto asset form of raising those funds. There has been a lot of negative press on what are called ICOs, or initial coin offerings. Think of this as a security offering that's out there as a cyber asset to which SupraFin could become a potential distribution path for the particular venture investment that you've brought to them. So that's why I think this could be very interesting for the venture community over time as this kind of platform starts to take hold. What's also interesting here is that you have fairly sophisticated capabilities in the future where you could actually get this to be, perhaps have some artificial intelligence to how that portfolio is selected, how the risk assessment is made. You could move to a fairly interesting platform in the future where a number of our kind of ventures could be funded perhaps using a distribution platform such as this. Again, this is launching next month. It does have some interesting aspects to the platform. I mentioned financial inclusion, the customized portfolio. There is the ability for the investor to have monitoring so they understand what the assets are doing, what kind they own, and perhaps be able to change either the risk profile or rebalance the portfolio. And again, they will have a number of capabilities to help you understand what's on the what's in your wallet, so to speak, of various crypto assets. So that's SupraFin, and that's you know, to me, a very interesting development. Coming back to the reason for this project is how do we help ventures get more funding in the future? And I think this is an interesting approach that could start to add to that. But let's take a step back now and ask ourselves, why do we seek equity funding? And as we seek that equity funding, what happens if it's tough? Or to come back to COVID-19, what am I recommending and working with a number of my companies on in terms of adapting to the new times right now and understanding this pandemic? So I'm going to talk about seeking equity funding. And really, there's four reasons why companies seek it. The one that we all think about normally is to grow the business. And that growth could be both organic, as in taking the product and moving it forward, or going into new markets, or changing where we are in the value chain, backward integrating or forward. It could be to go buy other companies or to buy technology or capabilities to do some form of merger or acquisition. And it could also be to go and say, hey, we're going to spend this money on research and development. It's something that we think will pan out in 1 year or 5 years or 10 years. And that's really part of our growth plan, is to build backwards in the engine of the company, so to speak. One of the things, one of the individuals that's worked on this Tech Cap Markets project is a woman at ESA called Julia Prats. And I've been absolutely a pleasure to know her for many years. I'm part of a CEO forum that she taught us a number of years ago, something that we've called the suicide cube, which is, as you're thinking about growing the business, you can grow it in terms of product, you can grow it in terms of new marketplaces, and you can change the business model. For example, go from in the case of software, from a perpetual license model to software as a service. The interesting thing about Julia Pratt's suicide cube is it makes sense to go on one dimension. If you start to do 2 dimensions, oh, I'm going to introduce a new product into this new market, you're starting to go down an area that could be very, very difficult. And committing suicide is when you decide to put a new product into a new market with a new business model. And that's something that clearly you don't really want to spend a lot of equity funding to go do if it has that kind of risk profile. So growing the business is a normal thought process for equity funding. Second category is protecting the business. A lot of the small companies I work with have very, very little cash on their balance sheet, or have some fairly expensive borrowings that they want to clean up. Or it could be just in the case of risk mitigation right now, you want to have extra cash on the balance sheet or extra things you want to do to protect the business. The third reason is a transfer of ownership or management to seek equity. So somebody's buying out somebody else, or you're moving it from one form or one owner to another owner. The last one is the one that's most disliked by equity funding sources. And that is normally when you put money into a company, you want to see that money used to grow the business in some fashion. And usually if you have a venture founder taking money off the table or chips off the table, that's always a difficulty for equity funders to want to see. It does happen, but I'm just saying it's one of those things that's, it's not frowned upon, but it's always a question of, well, gosh, wouldn't you rather go make this a bigger company and your value, your shares are worth more rather than taking some chips off the table. So again, I talked about two platforms and two new ideas. I want to come back to what happens if you can't get funded, or what alternatives are there to not getting funded. And this reminds me of a comment that was made to me many years ago. Businesses only go out of business for one reason, and that's they run out of cash. And so the next slide I'm going to talk about is ways to think about your company and what you can do. Two alternatives. What alternatives can you do to if you don't find funding? So when I go into a business, I often will start in a very thorough, diligent fashion by looking at the accounting statements in a fairly different way than the accountants would normally look. So if you think about the income statement, basically you have revenue less costs and equals profit, to be very, very simple here. And the first thing that most people do is they look at their cost base and they say, okay, what costs do we have that we could reduce, and how would we go about reducing those costs? And that could be anything from suppliers to employees to all sorts of different ways. And again, all of us have done this in some fashion in the past. But one of my mentors once said, Keith, you can't save your way to salvation. You've got to think about top line growth as well. So the question is, can you sell more to the same customers? In one of my companies, we've gone to every customer and asked them for a referral. First off, it starts the conversation of, are you a happy customer? And second off, if you're a happy customer, do you know others that could benefit from our services? And so the next thing you try to do is there any way to boost those revenues? Any way to get more money from each customer or more customers? You then go through the process of the balance sheet. Classic, looking at all of the assets. Is there a way to leverage those assets? Is there a way to increase the borrowings on those assets? Is there a way, classic, to increase your payables or decrease your receivables? There's a problem when you increase your payables, which is you're forcing the issue onto your suppliers, and you're telling your suppliers, yeah, I'm not going to pay you in 30 days. I'm going to pay you in 60 days or whatever. And that can be a very destructive process to the supplier relationship. And so one of the things that you always want to be careful of in this situation is to look carefully at, are you in fact passing harm on to others, or are you taking advantage of others in your particular constellation? And then there are other things on the balance sheet that you can look for that could be research and development credits. There could be grants out there, other forms of moving around. I then move to the cash flow statements and understand, are there particular expenditures? For example, this could be maintenance, where instead of maintaining some type of asset once every 6 months, maybe you move that to once every 9 months. So you think about, where are those expenditures happening, and is there an element of time that could be changed? You also look at alternatives to what you're doing, or to the particular processes that you've got coming in. Where can you do substitutes? Could you outsource? Could you share an asset? You know, one of the reasons why car ownership is such an interesting area is, if you look at your car, you probably use it, if you still own one, 4%, I believe is the number. 4% of the time a car is actually actively being used. And so if you think about the sharing of assets and the sharing of those kind of capabilities, whether it's in a simple case of a home, you could have tools or lawnmower, et cetera. So one of the things that it's an opportunity to think about not getting funded is to find ways to use the funds that you have, use the company you have in a better way, to use the cash flow process. So I want to finish with an example of some ideas that I've done, and then we'll open it up. John's probably got a few Q&A questions for me. So if we think about it, NanoRadio was a Wi-Fi chip company that I worked on, a very interesting little company. Was in cash flow crisis when I got there. I went to the fact that we managed cash on a weekly basis. So I actually turned off every single payment and understood, what's this payment for? Why do we have this supplier? What do we do with this supplier? What do we use? And I then created an owner of every single outflow and every single inflow. So in the case of an inflow, you have a customer, you have an account manager. I would make sure that account manager knew when we were invoicing, knew exactly when we expected to collect that invoice, and that account manager was on the hook to make sure that we got that money on the day that that account manager said we would get it. And we had ways to understand what, in fact, our customer was doing, when we were going to get paid. So it's really a matter of accountability, pushing it down to where every single individual payment or receivable had a person that I could look to and say, how are we doing? It's supposed to come in on Thursday. What are you doing to make sure it comes in on Thursday, et cetera? And we had a very detailed schedule of each of those payments and each of those receivables that we managed very, very carefully. In this particular company, we had some yield problems where we would go out and our wafers were supposed to create 1,000 Wi-Fi chips. And we were in fact getting more like 700 Wi-Fi chips off of a particular wafer. Because of this, where we expected to get more than that 700, we started letting customers down by not providing the amount of chips that we said we would provide on the timing that we said that we would send it to them. So we had unhappy customers because of delivery problems. The solution that I used, which is this is a very simple solution, but how do you match supply and demand? How do you get this to be together at the same time? And in this particular case, I did a fairly large price increase. That price increase created obviously some unhappy customers. We had some that didn't buy it from us any longer. But the ones that were happy and were able to work with this price increase became very happy because we delivered exactly when we said we would deliver. And these were very complex Wi-Fi chips for particular mobile devices. So we were able to then match demand and supply and get through a bit of this issue. However, we still had the problem that we were growing this company in excess of 30%. We were going through huge amounts of working capital. And the difference here is on a profit and loss statement, we were profitable. But because we were growing so quickly, and because we had a situation where much of our cash was spent well in the long before the customer paid us for the Wi-Fi chip. In this case, we had as much as 26 weeks before starting a wafer and getting payment for that Wi-Fi chip from the customer. We really were eating a huge amount of working capital, or needing a large amount of working capital. So what we did is we did an end-to-end review of the business model and found a way to alter or negotiate terms all the way across the business cycle in order to turn this around. And frankly, in order to avoid funding, because we weren't in a situation where our owners wanted to give us additional funding. So that's an idea that could be used by you in terms of avoiding funding, or in the case of COVID-19, finding ways to make your cash last, make your company go better. So I've gone through and worked to give you two new ideas or different platforms: the Consilience venture platform of matching investors, advisors, and ventures using a token, and the SupraFin platform, which enables you to, as we think about a potential distribution path for putting out a form of digital security for your company. I then gone back and said, okay, let's go old school. What are some of the ideas for avoiding funding and, or not avoiding, but being able to stretch the current cash? So I'll go back to Jean and open it up to questions and answers.
Well, I'd be delighted, though I can't see any questions so far. So I would advise any attendee to either put a question through the Q&A interface. It's in the lower part of your screen in the menu, or just you have a chat option and you can type any message there. In the meanwhile, Keith, I might have a question or two. The first is, I just saw that Bitcoin rebounded today after taking severe hits in the last days. With your interest in crypto assets, what would you say of the future of Bitcoin in general, which I believe is something like 2/3 of the total value of crypto assets? So do you think that they are in a way aligned with the rest of the economy and will not be